What if I told you that the most boring investment strategy in the world has beaten Wall Street's smartest fund managers? Year after year, decade after decade. No fancy algorithms, no insider tips, no stress. Just a simple, steady, unstoppable machine that's been building millionaires since 1957. Today, we're talking about the S&P 500 and why boring, in this case, wins the race. Welcome back to Cashflow Hacks. If you're serious about building real wealth, hit that subscribe button right now. Let's get into it. First, what exactly is the S&P 500? The S&P 500 is an index of the 500 largest publicly traded companies in the United States. We're talking Apple, Microsoft, Amazon, Nvidia, JP Morgan, Johnson & Johnson, all in one basket. When you invest in the S&P 500 through an index fund or ETF like VU or SPY, you're not betting on one company. You're betting on the entire American economy. And here's the thing, that bet has paid off every single time, as long as you were patient enough to hold. According to Fidelity, the S&P 500's average annual return has been about 10% since its launch in 1957. Over the last 40 years, that average climbs to 11.5% per year. Not 10% every year. Some years the market goes up 25%. Some years it drops 20%. But over time, the long-term average holds steady, like clockwork. Fidelity math that will change how you think about money. Let's talk about what that 10% actually means for your wallet. Because this is where it gets wild. If you invest just $500 a month into an S&P 500 index fund at a 10% average annual return, after 30 years, you end up with over $1.1 million. After 40 years, that number jumps to over $3.1 million. Speed calculator, think about that. $500 a month. That's less than what a lot of people spend eating out. And the reason this works isn't magic. It's compound interest. You earn returns on your original investment and on every dollar of growth you've ever made. According to NASDAQ, if you invested $500 a month and hit the $500,000 mark after 24 years, you'd earn the second $500,000 in just the next 7 years. The snowball gets bigger the longer it rolls. The hardest part isn't the math, it's having the discipline to start. NASDAQ. Most smart investors lose to the S&P 500. Here's a step that Wall Street does not want you to know. According to S&P Global's 2025 SPIVA scorecard, that's the official report measuring active fund managers against index benchmarks, 79% of all actively managed large-cap U.S. equity funds underperformed the S&P 500 in 2025, 79%. These are professional investors with million-dollar research teams, Bloomberg terminals, and decades of experience. And they still couldn't beat a boring index fund. Zoom out to the last 20 years, and that number gets even worse. About 92% of domestic active funds underperformed their benchmarks over 2 decades. S&P Dow Jones Industrial Management. So the next time someone tries to sell you on a hot stock tip or a can't miss actively managed fund, remember that number, 92%. The secret weapon, low fees. Here's the part people overlook that quietly steals their wealth. When you invest in an actively managed fund, you're paying for all those analysts, all that trading, all that overhead. Active fund expense ratios typically range from 0.5% to 1.5% or more per year. That might sound small, but it compounds against you just like returns compound for you. Invoice Fly Compare that to Vanguard's S&P 500 ETF. VU charges an expense ratio of just 0.03%, meaning you pay $3 per year for every $10,000 invested. That's basically free. On a $100,000 investment held for 30 years at 10% average returns, you'd pay approximately $16,000 total in VU fees versus roughly $50,000 with SPY. That's over $34,000 extra in fees for what is essentially the same investment. Fees are the silent killer of wealth. The S&P 500, via low-cost ETF, keeps your money in your pocket, where it belongs. The motley full market cash was. Do you actually get started? This is where people overthink it, and that overthinking costs them years of compounding. Here's the simple playbook. Step 1. And a brokerage account. Fidelity, Schwab, or Vanguard all work. Takes 10 minutes. Step 2. Buy shares of VU, SPY, or if all three track the S&P 500. All three are low cost. Step 3. Set up automatic monthly contributions. Even $50, even $100. The amount matters less than the habit. Step 4. Don't touch it. Don't panic when the market drops. Don't sell when the news is scary. Roughly 2 out of every 3 years in S&P 500 history have produced positive returns, and the most common return range is between 10% and 20%. The down years are loud. The up years are quiet. Stay invested. Visual Capitalistant here's something to keep in mind for 2026. Specifically, all 21 Wall Street strategists surveyed are forecasting gains for the S&P 500 this year, with an average expected return of 12%. And if that happens, it would mark the 4th consecutive year of positive returns. Boring is working. It keeps working. Visual Capitalist, there's the bottom line. You don't need to be a genius. You don't need to time the market. You don't need to pick the next Apple or the next Nvidia. You just need to buy a slice of America's 500 best companies every single month and let time do the heavy lifting. The S&P 500 isn't exciting. It isn't flashy, but it has turned ordinary people into millionaires for decades, and it will keep doing it long after this video ends. Start today. Your future self will thank you. If this video gave you value, hit that like button and subscribe to Cashflow Hacks for more content that actually moves the needle on your financial life. Drop a comment below. Are you already investing in the S&P 500, or are you just getting started? I want to know.